similar to that of a shooting star, probably just stretching beyond the acceptable level, because normally those are referred to as small bodies. That usually means that they're about 20% of the total range are involved. This is beyond that. It's probably about 25 or 30% maybe, but it's still a massive rejection to a blow-off. We'll point out that we were getting in long on the primer wind here, when our best friend Brent Johnson was saying the pilgrims of silver are going to get excited that's going to go above $25 again. At that $25 point, we've had an amazing ride, and on the lower timeframes, we got out of our leverage positions at 118, and we even tweeted it at 111 out. We're done with leverage. In terms of blue pot accumulation, I think you're going to get an amazing opportunity, although I stress again, the delivery price is vaguely related to the cash casino price. There'll be a lot of other costs. There might be premiums. You could have discounts if you get people that are in distress. So you could have one of the best buying opportunities, but you should expect the next 6-month period to have at least a range that dips deeper down. It could be a red-bodied candle. It could be a green near the end, because 6 months is a long time. But you would expect with this level of momentum to the downside, if we're going into distress, and I think that's going to be hyperscalers, AI, private credit, debt, maybe a bit of the, a crisis on other nations, possibly a war escalation with Russia, who knows, any number. We've got so many risks to the downside that you will trade lower at the moment on silver. And it's going to be presenting amazing blue pot, unleveraged purchasing opportunities to me. But it will likely, during the 6-month, continue this momentum, because this is violent and it doesn't stop on a dime.
The paper derivative systems and bond markets show structural stress much earlier than equity markets. If we look beneath the surface of daily technical indicators, we can observe the foundations of a massive macroeconomic shift. The current era of central banking policy relies fundamentally on currency debasement. By continuously issuing debt and overexpending, the global monetary system naturally dilutes the value of fiat currency.
Although most people tend to think of silver as gold's poor sibling, the stunning truth is that silver...
Mainstream financial market analysis routinely suffers from delayed recognition, looking at short-term price adjustments while ignoring long-term structural supply deficits. The reality is that institutional capital is beginning a generational shift out of paper assets and into physical, tangible ones. The paper futures markets function primarily as a mechanism of leverage, attempting to manage supply imbalances through financial engineering. This structure functions only while institutional confidence remains intact. However, a clear divergence is widening between paper pricing limits and physical reality. You simply cannot print physical molecules. When physical material is demanded at a systemic scale, the paper market loses its power to suppress value. Severe physical scarcity is driving this transition forward. Above-ground vault inventories face continuous drawdowns. At the same time, base supply remains highly inelastic. Developing new mining production profiles requires massive capital allocations and years of exploration. Production cannot quickly expand to meet rising demand. The physical market is structurally tighter than the paper system reflects. Silver has spent an extended period carving out a solid technical bottom. In past cycles, when a suppressed commodity finally broke through its long-term resistance channels, it re-rated rapidly to reflect its true physical scarcity. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Make sure to check out our other videos on the silver market and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
Well, it's always the higher beta. I'm going to make one quick comment just before I deal with silver on something you didn't want to go too far down on, and that's the stable coins and treasuries. I'll make one comment and one fact. The biggest, the notion that stable coins will bail out as huge buyers and will shore up the bond market. The biggest the biggest stable coin is Tether USDT. Its total market cap is 186, and they've purchased I think in the regions of around 140 to 160 billion in collateral, and they've more recently been looking to add gold and even gold miners, and have added gold and gold miners, so they may not even have 160 billion. This was established in 2014, and that's its total market cap today. And if I tell you what that percent is, I had the maths done because I was having to deal with this trope that was becoming really popular, that, you know, stable coins is going to hold up the bond market. But that is the biggest and the largest. And 160 billion, the issuance in 1 2-month period was in and around 600 billion. So you didn't even cover 40% of 2 months new issuance, never mind everything that's been issued. And I did the numbers of 160 billion on the 38 trillion. And you are talking not even a little boy's pippy in the ocean in terms of backup. Now, people will say, well, there's more than just Tether, there's USDC, and they'll all follow the same, and there's others. You can multiply it by 5. It's still 5 little boys pippy in the ocean. It is not going to be holding up the market. That is cope, people taking refuge. You just have to look at the numbers on that. It's not going to happen. And stable coins would have to become 36 to 38 trillion in total of market cap to actually be offering that level, or to anywhere close to that level. And I mean, they're miles off that at this moment.
Absolutely.
So there's
I appreciate that statement. Yeah. No, I appreciate that.
It can't happen, but there would be a bunch of market caps are going to have to go very big, very fast, and a whole bunch of new buyers showing up. So silver is very much similar to gold. Of course, the correlation is there, even higher beta. This is a blow-off rejection. The candle now has got almost too big, the candle body, to be referred to as a shooting star. Although I will say the wick is still substantially longer than the body. So it is similar to that of a shooting star, probably just stretching beyond the acceptable level, because normally those are referred to as small bodies. That usually means that they're about 20% of the total range are involved. This is beyond that. It's probably about 25 or 30% maybe, but it's still a massive rejection to a blow-off. We'll point out that we were getting in long on the primer wind here when our best friend Brent Johnson was saying the pilgrims of silver are going to get excited that's going to go above $25 again. At that $25 point, we've had an amazing ride, and on the lower timeframes, we got out of our leverage positions at 118, and we even tweeted it at 111 out. We're done with leverage. In terms of blue pot accumulation, I think you're going to get an amazing opportunity, although I stress again, the delivery price is vaguely related to the cash casino price. There'll be a lot of other costs. There might be premiums. You could have discounts if you get people that are in distress. So you could have one of the best buying opportunities, but you should expect the next 6-month period to have at least a range that dips deeper down. It could be a red-bodied candle. It could be a green near the end, because 6 months is a long time. But you would expect with this level of momentum to the downside, if we're going into distress, and I think that's going to be hyperscalers, AI, private credit, debt, maybe a bit of the, a crisis on other nations, possibly a war escalation with Russia, who knows, any number. We've got so many risks to the downside that you will trade lower at the moment on silver. And it's going to be presenting amazing blue pot, unleveraged purchasing opportunities to me. But it will likely, during the 6-month continue this momentum, because this is violent and it doesn't stop on a dime.
Francis,
it's important to mention that there is a technical 45 to 50 breakout zone, and I'd imagine that to be tested. And I think at a wick level, you could trade through it, but not close beneath it. So what is typical, in our rules, we talk about key levels. I prefer zones than trying to put in one exact number. You can call that the 50, the hard ceiling, and you can call the soft ceiling the 45 if you like. So we had a $5 mark where we traded into but didn't close. all of these candle bodies are well below even 45. I can tell you what this one is, the highest one of 1980. The open was $37. That's $37. So you didn't get any form of candle closure in the 45 zone. I could have even made it 40 to 50. So that's a void zone. We really battled to close in that. Now we broke above that. That turns into support. You could get a wick down to, into the 30s potentially, but not close there. And the eventual 6-month hammer closes, I would say, is still above 50, but you will have traded maybe at $37 during the 6-month period. So a very good negating candle. If we were to get our best outcome, bear in mind, this is not guaranteed, your best outcome of rejection. You go into a crisis, you sell off, and you'd have something like this. Ideally, a green candle here that will be in the 50s. Let's say it closes where we are now, 57, and you get a testing wick like that. That tests that 40 to 50 zone. The way I've drawn it, it's more like 45. Well, actually, maybe it is 40 because this is 37. 40 to 50 zone, you can trade in here intra-period, but it's not a closing point. In other words, the zone of the 40-50 survives a temporary test, but not a close below or in it. And that would be a great hammer that would negate the bearish momentum to the downside that you've got going. But this is still going to be some form of a crisis. You could dip a little lower. You might even get to 30. For us, the HVF setup, the funnel is here. Most people are cup and handle traders. To them, everything happened here. We were already long on a priming squeeze in here. And the main HVF funnel, which is often tested, is in and around the 29.30. So you could be very unlucky if it's a massive crisis and a credit and you have a 60% crash in the NASDAQ and everybody's in trouble and everybody's had margin debt and now everything's being sold and it's auctioned. Think of the lows of post-Lehman, the absolute drama of post-Lehman. The financial pages have now become the front pages. If you get that sentiment, it's not beyond the possibility that you get that. This is not a prediction. It's not my highest probability prediction, but it can happen. And that would be an unbelievable entry, just like that. And this was a hammer that rejected the CV19 event. Now I've got it right. Thanks for keeping me honest, by the way. And the subprime, where was the subprime contagion? That was the subprime contagion sell-off. And that's in silver, the far more skittish, higher beta. You all went on upwards afterwards. So these were big events and the market went up. And this was a big event. And, good luck trying to get it at just $11.50. Most people paid 14. But if we've got a lot of people in stress, you could even have a discount. Right now, I'm being able to purchase with a discount to spot. So that tells me there's distress. And that's why I hand you back that number, that headline word. And that's a liquidity distress, by the way.
Sharp, sudden sell-offs are common in these setups. They frequently occur when over-leveraged institutions face margin calls on highly valued equity or tech positions, forcing them to liquidate their liquid gold and silver holdings to raise cash. These brief, violent drops fracture short-term speculator sentiment, yet the core structural trend remains entirely unbroken. Let's get back to the rest of the interview.
So shooting star, this candle is normally going to be followed by another red candle, typically. So whenever you've had shooting stars, I'm looking for a good example in the current gold chart. I think I'll find better examples. We don't have too many such. You started to get shooting stars here. You can see you ended up with a bear move that followed. This is a very aggressive one after. We have to bear in mind from that 2000 call, you had on the 6-month chart, that's a green candle. That's one. I'll just count them out for you, by the way. From the consolidation, 1, 2, 3, 4, 5. Whoops, that's 5 over there. That's 6 and 7. 6-monther candles. That's half a year. 7. That's 3.5 years of every 6-month period closing higher and accelerating continually into that. Everybody now wants to throw the baby out of the bathwater, or throw the bathwater out the baby. I don't know which one. I'm getting my dyslexia provoked here and my autism all at once. But the key thing is everyone's mad as all hell now, because you're going to lock in your first red candle in 7 greens. From the 2000 event that we sat with you way back, we were talking back tail end of 23, saying once, twice, 3 times, 4th time a lady, you're running, you're not seeing 2K again. And I don't think you will be seeing 2K again, but you could see lower numbers. So typically what follows this 6-monther, if it locks basically where it is now, is probably a red candle, maybe with a deep wick test down on a crisis. And I can point you to, here was CV19s, by the way. That's how you shake off a crisis. That was the COVID sell-off. Did it spoil the bull market that you were in? No, it didn't.
That was the global financial crisis, Francis.
Sorry?
That was the GFC.
Subprime. I've got the wrong one. The COVID is, because I'm on such a big time frame. Thank you for correcting me, by the way. I don't like talking nonsense. And I was. The CV19 actually did have a sell-off. It doesn't even reflect on the 6-monthly. I was assuming that was it there until I checked down there. That was the whole of a subprime, a depression, as far as I'm concerned. Bank failures, a number of countries that were 2 years basically without growth in a row. That was a depression. That was what gold did during that, midway, only to trade higher. So people need to calm down. I think you'll probably get another red candle, possibly, but you could trade down. You could make a little body. You could have a downside wick. And by the end of the 6 month, maybe this is back green again, and you've shaken it off, and then you're ready to go further. So that was gold. Let me hand back to you, and you can call me in if you want me to go through silver.
Yeah, absolutely. We'll talk silver in a second. I'm just curious. Like it feels like, just looking at and I'm not a chart technician by any means, but it feels like we might be seeing a third, fourth cup here being built out as well. Do you see any reason to believe that that could happen? Like you just mentioned U.S. dollar strength, for example, that could be a headwind for gold in particular. Bond yields are dropping as well. Dropping is a maybe strong word, but it going lower at least. Yeah, what are the odds of that?
The problem they have is they have 10 trillion to roll again. Rates are very, very high. And the only way you have left to get a bit of money to run in the bond market, don't forget, our call in 2020 was the turn of the bond market in September. Since then, it was validated by Druckenmiller and Paul Tudor Jones in 2024, saying in terms of debt, that market is a busted flush. You should not be long bonds in any sense. Yeah, taking you to 4.2. So not only are you 90% above in altitude where you should be, you've just turned into a rocket and you're mooning at 0.4% further in a single month to the upside. How on earth can you be astounded that some people think that rate increases may be needed? If you are even semi-serious about the inflation mandate. In fact, the question to me is, what are the 9 that aren't thinking about rate increases actually doing there? If they're happy with 3.8 becoming 4.2 in 1 month on a target of 2%, what are they thinking that they aren't seeing a single rate hike? So to me, I thought it was over the top reaction. I think the losses that you'll see, or the cash price, let's remember, it's not what's going on in the casino price is not what you'll end up paying to have delivered. But what's going on in the casino pricing is already pricing in the expectation of at least some rate prices. Yes, it will go a little bit further, but I think very quickly on gold and silver, we'll start to hit floors. So the reaction, the market is a forward discounting mechanism. So what you're already seeing is already bearing in mind that at least one of those rate hikes may indeed happen. Possibly it might be pricing in 1.8 hikes, for example. And so there'll be a little bit of a reaction, but maybe not as much as you think on the basis that some of it's already been priced.
Current advanced technical analysis projects silver to break out of its multi-month consolidation patterns. The mathematical case for silver is not a matter of short-term speculation. It is an inevitable adjustment driven by the decay of paper debt systems and the limits of physical supply. The institutional derivative markets cannot permanently override a physical deficit. That's all for today, folks. Thank you for watching, and keep stacking physical silver.